What's going on, YouTube? We got to talk about what happened to the portfolio today. We got destroyed, down over 8.5%. I was at all-time highs starting off the day, and now we are definitely far from all-time highs, down around 8.5%, like I said. Now we got to talk about what we can do to profit off of this, because this is a great opportunity if we can profit from it, if you have the knowledge to profit from it. So that's going to be the main focus of this video. Also breaking down what is going on, what my opinions about this, all this selling coming in is due from. So before we get into that though, my name is Tyler. If you are new to the channel, hit the like button and the subscribe for the YouTube algorithm so we can push this out to more people and help them as well. First things first, guys, nothing really happened in the stock market that changed a lot of these companies' valuations. Now we've seen quite a bit of short squeezes, and I think that's part of the reason why the markets fell today. I think it's a lot of people just exiting positions and booking some profits, which booking profits, guys, is never a bad idea, especially if you're up on more speculative companies. Now, when these institutional investors start booking profits, you see a lot of sell volume coming in. So you're going to see the whole market tank downwards, especially with the climate we've seen going on. That's just going to happen. But companies like Apple that just reported earnings and passed 100 billion in revenue for the last quarter, for the first time ever, just had their best quarter, added 3.7 billion dollars in cash to their balance sheet, almost reaching 200 billion in cash. That is insane, guys. Tesla just reported their 6th quarter of profitability. Now I'm gonna play a interview from CNBC with Rich Bernstein and see what he thinks about the market.
Nation, I'm Seema Modi, one of Wall Street's all-star investors, predicting extreme speculation will create significant opportunities for those with patience. Let's turn to Rich Bernstein, an institutional investor, Hall of Famer. He runs Richard Bernstein Advisors. It's good to have you on a day like today where we do have a lot of questions. So Richard, let's get straight to it. What do these giant short squeezes, particularly in a name like GameStop, suggest about the broader market, where we're headed from here?
So, Seema, I think it really talks to sort of the bifurcated market, where we have one part of the market which has become ridiculously speculative, and then another part of the market which is almost totally ignored. And I would argue that there is tremendous opportunities in the portions of the market that are being ignored that nobody's talking about. But the other part, you're basically playing with fire.
Is this a speculative bubble? And if so, what's the argument there? Why is it? Or is this just a group of traders who are using an online public social chat platform to discuss where they see opportunity, and they are just picking names that traditional investors typically wouldn't bet on?
So I think it's a number of things, Seema. I think, bubbles show up in a number of different formats.
Most of the companies that have reported so far, I think 3/4 of them have beat earnings and have had great upward positive outlook going forward for the future. So it really doesn't make sense, but Robinhood made this article to kind of put some sense around it and to help people get at ease of mind with what's going on right now. So I'm going to read that to you guys as best as I can right now. This was just posted today. It says the stock market has been super volatile. How can I make sense of it? It says the key takeaways are, at its core, volatility is a measure of change. So short-term investors might perceive volatility as a potential risk, but long-term investors don't necessarily see it the same way. Volatility can be heightened during times of uncertainty. And I would say now is a great time of uncertainty. With that, though, I think after this earnings season, we will have a much better outlook and guidance on what the market's going to do for the rest of the year, which I believe will be very, very positive. It goes on to say this is a graph of the S&P 500. Everybody knows the crazy growth we have seen, and this trajectory is bound to keep going. There's more money flowing into the market, so that's not something you guys should be worried about. People are not, if you're betting on the stock market crashing or you think it's going to zero, you're betting the whole economy goes to zero or crashes or something. Usually the stock market should align with what the economy is doing. Not always, but most of the time. It's a stock market move. On its face, that might seem like a simple question. Generally, many people buy and sell options and ETFs, among other types of investments. On some days, there are more buyers than sellers, and on other days, it's vice versa. Extreme volatility can occur for many reasons: a sudden swell of investor exuberance or despair, example, the dot-com bubble, underlying financial problems, the subprime mortgage crisis, or in response to a major disaster like COVID-19. During these times of upheaval, it might seem like a different industry or company is under siege practically every day. While it's tempting to think of stock prices as a straightforward case of supply and demand, many factors actually drive the market, especially under the surface. Some influence specific industries or companies, like product recalls for contaminated vegetables or defective vehicles. Once in a while, though, the entire market can get rocked. In a working paper published by the National Bureau of Economic Research, economics say that before COVID-19, no infectious disease had ever made a sizable contribution to U.S. stock market volatility. Regardless of whether you're thinking about stocks for the first time or you're a seasoned investor, understanding a bit about volatility can help you mentally prepare for the market's unpredictability. Here are some basics. It says, please buckle up. That is very accurate. Basically, the gist of the videos, the news reports coming out and all this, and just looking back in history itself, that this is only temporary and the stock market does tend to go up in the long term over time. Now, if you have short-term positions, I'm sure glad I don't, because they would have got destroyed today as far as calls or anything of that nature. If you guys are in a lot of short-term plays, there's not much you can do beside ride the wave and hope for the best, unless you sell out and take the loss. Now, if you're in longer-term positions like stocks and even longer-term options, you have more flexibility. But I'm going to show you guys how you guys can hedge your long-term stocks positions by using puts. Now that we are back over to the Webull, I am going to show you guys what I would do if I wanted to hedge some of my long-term positions. Now, some of my biggest positions like NEO and Big Commerce, positions like that, those are really the ones that you'll want to protect more, because when you're buying puts on your positions, it protects you from the downside, especially the closer to the money you buy. So as you guys can see, I have a $4,500 position in NEO, and it is 17.55% of my portfolio. Now, NEO did go down a lot, so it was more than that before, and I do not have any puts or anything to hedge my position. As far as my personal portfolio, I did not hedge any of my largest positions, just because I do not think this is going to be a prolongated event of this downward trend with most companies. Now, if you do feel like you should, and plus I don't have very much margin outstanding, I can spend like double what I have used, so there's no risk of a margin call in my opinion. But if you do feel like you need to hedge your position, remember, a put or a call or any option is 100 shares. So if you take, depending what your average cost is, this might vary, but if you just wanted to hedge against any further downtrend, then you would want to first make sure that, one, you chose a strike price that was at least as far as you think this downtrend will last. So if you think it'll last a month, you could go February 26th, and then let's say you have 100 shares, and then you could just get one contract. And the risk here, like, buy one of these puts for $625 at $56 strike. So anything under $56, your 100 shares, assuming you had a 100 share total position, would be protected against every cent under $56. Really, if you had more than 100 shares, you'd probably want to get more than one put. But if you don't, then one will be fine for you. But the risk here is, if you spend $625 for this at the money strike, because you're going to be paying more premium, this is basically baking in the $6.25. If you know options, you know that each dollar on the strike price is $100. So this is basically saying that NEO will go to $50 by whatever the strike price is, February 26th. So if you agreed with that, then it would be a no-brainer, you should get it. If not, then you probably shouldn't be doing this. So that's my take on the situation and what's going on and what I'm doing for it. Again, I'm not doing anything to hedge any of my positions because I'm playing the long term and I have faith in the long term. But feel free to if you guys are worried about that. But I think that's all I got to say, all I got to cover in this video. So until next time, guys, peace out.